The U.S. right now is what's known as fiscal dominance, where both the debt and deficits climb so fast they overwhelm the Fed's ability to keep inflation low. And that could leave both the Fed and lawmakers with some uncomfortable choices. Joining me now is Charles Calomiris, professor emeritus at Columbia Business School. I'll still call you professor. Welcome. Thanks for joining us today.
It's a pleasure.
So it's ironic because we have some big investors like Bill Ackman today finally saying, all right, maybe the rise in long-term bond yields is done now. For those who think they are probably going lower here on slower growth, is there any word of caution you might sound?
Yes. One of the possibilities that's driving the long-term bond yields higher is concerns about inflation risk related to the cumulative effect of government debt. So we don't know exactly why the long-term bond yields have gone up, but certainly that's one of the possibilities that people are talking about. And that's related to this concept of fiscal dominance that you mentioned, the possibility that the cumulative effect of deficits will cause money printing to result from the unwillingness of people to continue to bear increasing amounts of government debt, which forces the Fed to step in and purchase the debt that is effectively printing money.
Yeah, you have a great piece for the St. Louis Fed if people want to read more about this. But you said a couple of the things to watch out for if we're entering this period is, for instance, a failed government bond auction. You know, there is some yield at which they might say, we don't really want to go at these rates. Now, it's probably not 5%. Maybe it's 7 or 10 or 20. I don't know what that number is. I don't know if there's any speculation about what that number is.
Well, I'd say that, let me say what's already agreed upon. If you read the February Treasury Department report, they already recognize that current planned deficits based on entitlements and other planned expenditures are already putting us in an unsustainable situation, which means that there's no interest rate at which we can sustain those deficits going forward. So it's really not a question of what the interest rate's going to be. But at some point, people will recognize that at no interest rate will they be willing to accept further government debt issues. And at that point, you have, as you pointed out, some kind of failure of the bond auction. This has only happened a couple of times that I'm aware of in American history. But what it means is that people sort of realize that we've hit this point. It's not an easily forecastable threshold. Economists can't tell you exactly where it is, but we know that if we don't do something, here's what's absolutely agreed upon. If we don't do something about the cumulative deficits that are being forecasted based on our entitlement programs, we will hit that point, and that will lead to some sort of convulsion in the bond market, followed by a very big increase in inflation.
Yes, because the only real options at that point are kind of turn to the central bank. And there's a warning in here for banks, which is quite interesting, about the fact that the Fed might have to stop paying interest on reserves, at the same time increase reserve requirements. Right. And that would be a big profit shock. And a lot of people might not realize that what's happening is really this kind of stealth monetization of the debt. It might come across as something much more mundane.